Picture this. It's March 2026, and a shockwave is absolutely ripping through the financial world. Hedge funds, the giants of Wall Street, are suddenly in a total nosedive. We're going to unpack exactly what happened in this massive market meltdown.
It all starts with this one brutal number, negative 4.3%. That wasn't just one fund's bad day. That was the average loss for a U.S. hedge fund in March. I mean, that's a staggering hit for an industry that promises to make money rain or shine.
And just to put that into perspective, this wasn't just a bad month. It was the worst global performance hit for the entire industry in over 4 years. We're talking about a serious, widespread financial bleed-out.
So you gotta ask the big question, right? How did so many of the world's smartest money managers get it this wrong, all at the exact same time? Let's dive in and break down what was really behind this historic meltdown. Okay, first, to really get what happened, you have to appreciate just how huge the damage was. This wasn't a problem stuck in New York or London, oh no. This was a wildfire that spread across markets all over the globe.
And this really tells the story of the global carnage. So while U.S. funds were down 4.3%, their European counterparts got hit even harder, dropping 6.3%. But wow, the real epicenter of the pain was in Asia. Funds there just plummeted, down a massive 7.3%. Literally no corner of the market was safe.
And get this, these weren't just passive losses because stock prices were falling. This was active, full-blown panic selling. Funds were dumping global stocks at the fastest rate seen in 13 years. They weren't just taking losses, they were running for the exits. And it wasn't just the little guys either. Even the absolute titans of the industry were not immune. We're talking about huge players like Balyasny and Exodus Point, both down over 4%. Even the legendary Millennium and Citadel's flagship fund took major hits. This storm was big enough to rock even the biggest ships in the harbor.
So what was the trigger? What sparked this whole inferno? Well, the source of all this volatility, it wasn't a bad earnings report or a central bank decision. Nope, it was a geopolitical event that sent shockwaves from thousands of miles away straight to Wall Street.
And hey, you don't have to take my word for it. Here's an expert, Bruno Schneller, laying it out plain and simple. The chaos was directly driven by the conflict in Iran, which caused these sudden, violent shifts in the market. That was the match that lit the fuse.
So how does a conflict way over there cause such huge losses? Well, it triggers something called forced de-risking. It's a fancy term, but here's a simple way to think about it. If your house is on fire, you're not carefully sorting your photos from your valuables, right? You just grab what you can and you run. That's exactly what fund managers did. They sold everything, their best stocks, their worst stocks, just to cut their risk and escape the flames.
And this contagion didn't stop with stocks. Not even close. The shockwaves rippled out into everything. Currencies were swinging wildly. Commodity prices were all over the place. Even normally stable interest rates became totally unpredictable. The whole financial world turned into a minefield.
But here's where it gets really interesting. Amidst all of this chaos, a really fascinating story started to emerge. A huge divide opened up between two very different ways of investing. It was like a classic showdown, human gut instinct versus cold, hard machine logic. And the difference is it's stunning, honestly. On one side, you've got your traditional human stock pickers who got hammered with negative returns everywhere you looked. But on the other side, you have the systematic, computer-driven strategies. And what did they do in the middle of a market apocalypse? They actually made money. They were up 1.1%. Unbelievable.
And if you want to see where the human-led funds got hit the hardest, look no further than the tech sector. TMT stocks. For years, these were the darlings of the market. But in March, funds that focused on tech, media, and telecom got absolutely crushed, dropping almost 8%. So how in the world did the machines win? Well, they weren't just betting on the market to go up. They were hunting for something called alpha. Think of alpha as profit that has nothing to do with which way the overall market is going. These algorithms were designed to spot tiny, fleeting patterns in the chaos. So while all the human-run ships were sinking in the storm, the machines were basically surfing the waves.
All right, let's pull back for the final piece of this puzzle. Because this whole event didn't just cause a bunch of short-term losses. It actually ripped the cover off a much deeper, much riskier reality that had been kind of hiding just below the surface.
Let me just throw a number at you. 312.5.
It probably means nothing to you right now, but it represents an absolutely insane level of risk that funds were taking right before the whole system cracked.
That number represents a near record level of risk called gross leverage. Put simply, it means for every $1 of their own money, funds were betting with more than $3 of borrowed money and other complex positions. They were balanced on a razor's edge. And that is why, when the market finally tipped, the fall was so incredibly fast and so brutal.
Which leaves us with a final, really important question for the future. In a world where a conflict on the other side of the planet can vaporize trillions of dollars overnight, is the human stock picker a dying breed? When chaos hits, is the unemotional, pattern-seeking algorithm becoming the only bet left that actually works?